Hey everybody, good afternoon. I'm Doc Severson with 12-Minute Trading, and I've got Dave Lukas over here with 12-Minute Trading as well too. Today is Fed Day, the 22nd of March in 2023, and I'd like to welcome you guys to our live webinar, our live analysis. We've got Jerome Powell on the podium, and as we are talking right now, he's actually giving his Q&A session. We've already got the Fed announcement out today. We know it's a quarter point, another hike in interest rates. And so what we're looking for right now in the next half hour or so that we're going to be together is what kind of language, what kind of messaging is Jerome Powell going to be transmitting out there to the world, and it's affecting everybody everywhere. Dave, what are you seeing out there today?
Well, so far, typical Fed day, right? So we got the bounce off of the kind of the retail traders piling in on the announcement, right? Certainty, markets always love certainty. And so there was either a quarter point rate hike or a pause. We got the quarter. I think that was all priced in. So you got that initial bounce, and then we fell back down, back to where we started. Now we're front running back up into Powell speaking. So I'm looking at the screen over here as Powell speaks is when we're going to really start to see what this market wants to do based on what he says. So if he stays cool and just hits it down the middle, I think markets continue to rally. They seem to want to go higher, and you can kind of understand, right? All this turmoil happening, banks and, the different stuff with Silicon Valley Bank, all that stuff happening, looking to be like we're getting over that, there hasn't been any new news on any new banks, obviously this week. And so Powell says, hey, I think we're in good shape here. We're ready to respond if anything does happen. And we're going to do things by the data, but for the most part, we're slowing down. If that's what comes across, I think markets rip. I think we see the next swing higher, and that'll be a nice run up until we have to deal with the debt ceiling, which is going to be a nice fun thing into May and early June.
It's interesting. The Fed funds futures are already showing that by the end of this year, any hikes that we're doing right now are going to be given right back again. So we're going to be in rate cut mode by the third to fourth quarter of this year. So what could cause something like that? I mean, I think we all intuitively know.
I'm watching my screen over here, and I love watching the NDX during these times, the NASDAQ, because it is so dependent on, lower rates or slowing down in rates, right? That an index really reacts big time to it. We were up 140 a minute ago, and we're down 8. Now we're up 80. Like, it's bouncing all over. So Powell must have just got started speaking, but I say the same thing. Like, it doesn't make sense to me. And the Fed said that they see 3 rate decreases next year. That was part of the statement, right? So it's like, why are you raising rates if you know you're going to cut them 3 times next year, or you're just putting out BS, right? So I don't know. To me, it just seems ridiculous. I think they're at the end of the rate hike cycle. I think that they've gone so fast. They're starting to break things now. I don't know if anybody knows this. In fact, we just got back from our mastermind group in Sonoma for the last weekend, and we talked a lot about these things. And the FDIC has 128 billion, or it did have 128 billion in it prior to SVB and Signature. And now everybody's come out and yelling, and the Fed have made all the depositors whole in those banks to the tune of 260 billion. So there's nothing left in FDIC. So it's funny where they say, oh, taxpayers aren't paying for this. Where's the money coming from? They're printing it, right? So we're in this world where the balance sheet of the Fed went up 300 billion in the span of a week. So you think inflation's done? I think we're going to stay in a high inflationary environment. They're going to reset the goalpost to a point where it's not a 2% target anymore. Maybe it's 3 to 4%, because that's the new normal that we have to live in. And they have to be careful not to break the whole financial sector. I don't think that they care so much about the smaller regionals as much, but their board members are the big boys, the money center banks. Those are who are on the board of the Fed. That's who really is the Fed. So those guys are going to continue to be protective, like we saw in 2008. Once you understand that, you understand the motives of the Fed and everything else.
I think the real fear here is not necessarily anything that we're seeing today. The real fear is down the road is stagflation, where we have actually the inflation sticks around, but the Fed has done such an excellent job of destroying employment and growth that those two, we can't get them started again, right? So the starter motor's
We're
worn
there
out.
now.
Yeah.
We're there now. Inflation is entrenched, right? And think about it. In order to beat inflation, the Fed would probably have to go to maybe 8 to 10%. How's that gonna play with the financial sector if that happens? How's that gonna play with the rest of the economy? And we're kind of in this world, unfortunately, where the powers that be. I just actually put a podcast out on my Misfit Entrepreneur podcast about this today, and we're in this world now where no one wants to allow any pain, and that's really started in 2008. Like, and you can think about it. We're at 33 trillion in debt as a country in the U.S. We're still the dog of the least fleas because we're the reserve currency, right? So we've got that, right? That some of that's changing, but it takes a long time for reserve currencies to change to new things, and we may just get to a point where there isn't one for a while. That's happened in history too. So you got this massive debt. It's growing like crazy. We added $7 trillion in debt in the last 3 years alone. So it's going to continue exacerbating itself. And that's going to weigh on things. You've got the financial system, which is all debt. The mark to market on the holdings of the banks is over 600 billion. So basically what got SVB in trouble, it's a lot bigger. It's 600 billion across all the banks, right? So, they're all kind of underwater. So I don't see how that they can't just keep coming to the rescue as needed, unless they want to let the whole thing just kind of go under, wash out, and restart again, right? So that's kind of where we're at. We're in this perpetual, crisis comes up, we come up with something on the fly. What was the term they came up with? Term asset deposit something, right? It's like TARP in 2008, right? So they just came up with that. That's a new program, and it's FDIC insured. We're going to, you don't have to pay anything, but yet we just spent all the money of the FDIC plus 2 times more. And we're right back into where we're doing effectively QE, which is just printing more money and propping things up. So, that's our world.
There must be somebody. There must be somebody that they're paying at the Fed to come up with these branding names for. Yeah, don't call it printing money. Let's call it quantitative easing. That was 2010. Actually.
Right. Exactly.
Yeah. 20.
Right. So, and why don't you bring up charts? I know we've got some questions that are going to come in, and anybody that's watching, if you have any questions, give them to us. We want to do a Q&A with this today. Things are kind of holding right now with Powell. We came down some, now we're kind of back in the middle of the range. I think, looking at stuff, the S&P is up 7 points, right? So Powell's now 8-10 minutes in at the most. So the real fireworks probably haven't begun yet until he starts getting questions.
What I'm watching right now, this is the yellow box here is actually the opening range, which was, of course, we would expect that to be really, really tiny. There's the opening range from this morning, and where nothing was happening. And now what I'm watching, the main blue line here is the anchored VWAP, so volume weighted average price. So basically what we're looking at is anything below this line is going to be a discount to buy. And so you're going to see institutional investors defend this line throughout the day. So we're watching that become kind of a dynamic support and resistance line through today. So we're seeing that above par right now, but anything can happen in the next 10 minutes based on what he says. So looking at larger time frame charts, if we look at the larger SPX, we've been in this massive consolidation now. This has been since really May of last year. We're going on almost 12 months of this big, shock and awe kind of consolidation on the monthly chart, which is building up just a massive amount of energy. So both Dave and I are looking at this going, wow, whenever this thing takes off, it's going to leave, it's going to break some hearts, I'm sure. Looking at the weekly chart in the middle, here's the important thing. We're still making higher lows all the way along here, but at some point we have to make a higher high. We've got to get above 4,200. Otherwise, what happens is if we stall out here at 4,100 again and set up a lower high, what that encourages the bears to do is to really push for a breakdown below 3,800. So at this point, a break below 3,800 would be almost terminal for the S&P and would likely get us down to at least an undercut of 3,500. Now that's That would be sort of a lose the battle, win the war kind of thing, if that were to happen. Because I think if we undercut 3,500, we are going to have a massive amount of people just give up and say, well, the market's heading for zero here, so we're going to see absolute capitulation. We have not seen the capitulation yet in this market. So this would get us down there into that area. And I think we would see a massive, massive slingshot to the upside on the first piece of positive news from that point.
You've been saying for a while that this bear hasn't seemed to have that capitulation that typically you see before the end of it. And I've been saying maybe we don't have to have that, in this. And part of it's because we're in a new paradigm where Fed steps in and, FDIC's 250,000 per account. It's okay. We'll just do it all at no big deal, right? Like that's the world that we're in now, which is a completely different world than the last time that we've had a major bear market, right?
Right. So here's the way to look at that, because again, on the daily chart, we are in a downtrend. So even though we don't want to admit it, we're still in a downtrend. We're making lower highs, lower lows. So rule number 2 of fractal energy says that reversals start from the inside out. If we're able to put in some kind of a higher low, higher high, and start that process reverting back up to the upside at this point, that's going to be important, because that shows that then we do have the potential to get above 4,200. So again, I don't have a dog in this hunt. I don't know which way it's going to go. I don't know if we're going to break above 4,200. I don't know if we're going to lose it here and undercut 3,500. In a way, I'm kind of thinking that it would be a little bit of a shock to the system. It would kind of, quite honestly suck in the near term to have to go do that. But I think ultimately this would give us probably 2 years of absolute face ripping, like beyond. Yeah,
that would be the release of the monthly chart.
Yeah,
on the next chart over.
We would see something very similar to what we went through back in 20 and 21, right? We'd see that to the upside. So that would be short-term pain, long-term gain, or something like that. So what I'm also concerned with, though, like if we do end up breaking above 4,200, that it's going to take a war to get above that level, and it may not be, that may be the wrong move, right? We could see something like this happen. So I don't want to see us take the easy road out, because the easy road out's probably going to get faded from here. But
so many things to consider on this. I don't know if people know this, but the Fed just recently changed again how they calculate CPI. So if you haven't done any research on that out there, go do some research on that and check that out, because they changed it after 2008. They changed it again. And part of that is because it may be more favorable on how they can lower, the CPI amount, but you're still getting the inflation, right? Why are eggs still up 50, 60%, but inflation's coming down? People wonder that stuff. If you wonder why, go back and see how they are calculating it. And they make it complicated on purpose. But if you go and look and see what they're doing and how they're doing their weighting and the different things they're dropping out now and stuff like that, it kind of is it's almost like a contango. It's naturally taking inflation down. So, right. The dirty secret is that the Fed, the government, they really do love inflation, because part of our issue is, since we came off the gold standard in 1971, the dollar's lost almost 90% of its value, and it continues to lose that. That's why the Fed targets 2% inflation, because they know 2% people don't notice, right? But have you ever turned around a couple of years later, you're buying something, you're like, gosh, this used to cost so much cheaper, right? And you're just like, oh, well, when you buy it, right, it's not that big of a deal. But when you get an 8-10% inflation spike, you notice it right now. And that's when the proverbial pitchforks come out and politicians get scared and all that type of stuff happens, right? And so that's why the 2% target is what it is. In fact, Powell was on, when he did his song and dance for Congress a couple weeks ago, was asked exactly about this. And his answer was, why? They asked him why the 2% target. And his answer was basically, because it sounds good. That's what we want. There was no rhyme or reason or logic to it. It was just, in reality, he should have said, because that's what the public can stand without getting upset, right? That's really what it is. So
it's funny you
dollar's going to
mentioned that.
continue to lose value.
It's funny you mentioned that. I saw what I think is one of the funniest tweets the other day, because it was somebody complaining about inflation, and to illustrate their point, they said, this sushi through DoorDash used to cost me $18. Now it's $24. What the hell? You know,
Right.
like totally indignant that their DoorDash delivery had gone up, you know, for $5 or $6 at that point. And I'm like, wow, first world problems, you know, that life is tough, you know, but that's, you know, quite honestly, what people are using to measure their own personal gauge of inflation. In this case, it was DoorDash.
And I think that's what's going to happen is you're going to see, because of the new way that it's calculated that just started basically in January and stuff, is you're going to see inflation start to come down, but you're not going to feel inflation come down, right? And that's the thing, is that's going to be their whole, you know, we defeated it, we got back down to our levels, or, you know, maybe it's 3% now or whatever. But the fact is, inflation is going to continue to have. We're in that world now, right? You know, we've kind of gotten past that point of no return, where it's just going to be natural to have high inflation based on the amount of debt, the amount of money printing that we're doing, and all of that stuff. And that's just the way it is. And one of the best places to keep up with that is by trading the markets. It's why we do what we do, because you can drive that income to stay above that. Your money is worthless if it's sitting. I think anybody who's had money in a bank at, you know, for years at 0% now understands that, right? And so it's a currency, right? And it has to keep moving. You know, one of the most interesting things I ever heard, all money is debt. So if all debts were paid back today, there would be no money in circulation, believe it or not. So if everybody around the world paid all their debts off right now, there would actually be no money available, because it's all debt. And so that's the financial system that we're in. And so you have to keep it moving. You have to keep it moving. If it stays stagnant, it's losing. And so I think that's the key, is looking at how you can keep your money, currency, moving in the best way possible for you. And so looks like Powell's hitting it out of the park, because I just saw the NDX is almost up 200 points, and the SPX is up about 35 now. So talk about keeping that money moving.
Yeah, this is where we have this is where we want to be a little bit careful, because the NASDAQ right now is reaching a level. It's not to say that it has to stop, but this would actually be a great place for it to flag out and move into kind of a high and tight right now. But what you have is you have massive amount of energy powering this. So you've got these parent time frames that are like, that's a higher low. I'm leaving the station. Here's a higher low. Here's a higher low. I'm leaving the station. I've got a higher high here. And so, you know, NASDAQ has been just beat up over the last, you know, year and a half now. So this is, it's coming to the forefront. Now, you and I both talked about potentially the Dow. Let's see if I can bring the Dow up here. The Dow actually looks to be in the best position to rally, although it's not really doing so. But it may be playing catch up in the near term. I've got a bunch of fibs on here, which I can clear out. There we go. So the Dow, after leading the markets higher off the bottom, got itself into a position. Yeah, and it actually went to the downside first. This is kind of the move. This is the move that I was hoping would create the slingshot. Everybody looks for this move. Instead, what it does is it goes to the downside, gets everybody to just puke out of it, and then slingshots higher from here. So this is
that's the undercut of the 200-day, right? Now we're going back above it, and that looks like that's playing out. We talked about that several weeks ago. You had called that, right? And so we're kind of seeing that. We undercut it. Fear came in. We had a banking crisis and stuff, but it's amazing how fast we forget and things get resolved, and now we're headed back higher. This market just seems like it wants to go higher. And if it thinks that the Fed's going to be accommodative anyway, right? We're done hiking rates. We're going to come to the rescue of any financial issue that we have. Why wouldn't the market rally on that? It's got positive drift anyways because of inflation. It's going to continue to gain in value anyways over time. So why wouldn't it, right? So that's kind of what we might be seeing. Looking at some questions, Tim had a question. Won't rate cuts be negative to the market, indicating the economy is in worse shape? Traditionally, when the Fed starts cutting rates, yes, that's when you start to see markets act up, go down, right? What does the Fed know that we don't know? Sell. Again, we're kind of in this different world than we have been. And a lot of people want to look back on the past and say, well, this is what happened in the last time. This is what happens every time. And, we will see if that transpires. I think we're in a type of world where the Fed cuts rates. Remember, markets aren't the economy. You can have a recession and have a ripping market. You guys saw that in 2020 with COVID. Markets going to all-time highs. Nobody's working. Everything's shut down. The economy, GDP's negative, whatever, 50%. So, right? Market's not the economy. So markets want lower rates. Markets want easy money. So if they see that could be just helping the market go higher and stay disconnected from the actual economy itself.
So this is something I've just noticed here, and this is fairly positive. Right now, we have about a 50-50 shot of no rate hike coming up in May, and I think this is why we're seeing some positive movement here today. So this is a big change. This is a big change.
And he must be saying stuff to that too. And I can look at a feed on some of his latest of what he's saying here. He's blaming SVB management. Fed supervisors saw these risks and intervened. Well, in my eyes, they definitely intervened way too late, the San Francisco Fed at least. We don't know how significant or sustained the effect of credit tightening will be. We think it's quite real. He says they're going to be alert. So nothing big there. Don't know the extent of impact of tighter market or credit conditions. Well, credit's a big deal. That's where you get recession. When credit seizes up is when you start to see a real recession. So that's something to watch. I think the debt ceiling is going to be the next crazy time because they'll always wait till the last minute at midnight. His remarks on inflation, we don't see progress on core services inflation, excluding housing. However, it did point to stronger inflation. So it says goods inflation is coming down and that there is some disinflation that is occurring, right? So maybe the market's like that a little bit. So, but I don't see anything earth-shattering in his remarks right now.
Yeah, we seem to be keeping the gains here. So we did get a little bit of a slingshot move here as we went underneath.
He said there's not broad weakness in the banking system. So it sounds like he's kind of staying down the middle, which is good for this. Now, I think a couple of things. Watch the final hour of the day as we get into 3 p.m. A lot of times you'll see it, up right now while he's speaking. He leaves the podium and then it sells back off. I think tomorrow's the key day. I think tomorrow will be the real move. If we continue what we're seeing right now, and we don't sell off into the end of the day and we hold some gains and then we get some gains into tomorrow, I think that tells you that we're going to continue heading higher, at least in the shorter term.
Yeah, agree. It's always the next day. A lot of times you'll see the next day after a Fed day actually completely reverse. And we saw that a bunch in 22 where we'd actually get a positive day and we'd be like, oh, okay, good. Finally, the Fed's figured out how to speak to the market, and then we'd see it completely just sell off. It was just
we're talking big days, like
100
points up one day and then giving it all back the next on the S&P, which is a pretty big move. So, I think we seem to be, again, this market seems to want to go higher. It seems to be looking for an excuse to go higher. So I think I think after we get past this event, as we get into next week and stuff, I think we're going to probably see this thing continue at least higher in the short term. I think the NDX, I look at the NDX from the NASDAQ standpoint. You can look at the Qs, but I think the NDX is getting close to energy being out in that daily chart, 13,000, maybe it hits, and then that's where it finds some pretty good resistance. I think the S&P's got to get back up to maybe 40, 50 to 4,100. Maybe it'll see a little bit there before it is out of energy. So it's definitely got the ability to. Oh,
it's got the ability to go higher, and it needs to break 4,100 on the S&P with conviction from this move. Otherwise, it's toast. It's going to have to go lower to pick up a bid.
Yeah.
So we've got to see this thing get above 4,200 pretty quickly.
One other thing before we end today, and if there are any other questions, people go ahead and ask it. But one other thing that I wonder too, and I'd love your opinion on this. I sent out earlier today to our mastermind and you how it was a really good 2010 versus 2023 diamond pattern that's showing up on the large chart, right? The big diamond where, and you rightly pointed out that we broke and we just rocketed higher out of that diamond pattern that consolidated for months, right? Kind of like what you were showing on the monthly chart. And that was Bernanke starting QE, right? But a diamond pattern can break up, it can break down. So are we in a position where with the energies where they are, we just got this massive maybe 12 to 15 month move that, really just needs to reveal itself? Or can we just continue walking sideways in this range for a while? What do you think that,
a lot of
reality looks like?
If you look back on just about any major move in the market, there was always something that changed underneath the surface that most people did not pick up at the time. Like quantitative easing, it's not like there was a big billboard that we went outside in August of 2010 to say, oh, quantitative easing. So we're actually printing money and we're going to be upfront about it. And we're actually going to put it out as a schedule. Most retail investors, myself included, had no idea what had just transpired. And it was something that I think institutions picked up on really, really fast and kind of put the hammer down for a number of months. So is something similar to that going to happen and I'm certainly up for that, where we have a whole bunch of negativity that's out there. And currently there's a lot of negativity out there. A lot of people comparing this to, 2002. There's a lot of people comparing it to 2008, things like that. Mm-hmm. Negativity does help markets drive to the upside. But what has fundamentally changed? That I don't know right now. We're going to have to keep our ear to the ground to see if anything changes underneath the soil that we figure out later on. Like, oh, okay, it was obvious, we just didn't see it.
Yeah, I think the key right now is at least for me, I'm watching for which way that monthly chart does eventually start to break and trend towards, to give obviously that clue to that, because it'll last for a good year or so if that's what it does. We may continue walking sideways though through the next couple of months. We may have to get through the debt ceiling first before that thing really does release, right? And that maybe that's the catalyst, or maybe it is that we start up a bigger QE again and we call it something else. But just like the Fed threw 300 billion back in last week, right, and turned around from QT and added 300 billion. Maybe that's what it becomes. We did have another question come in, and this is a good one for you too. Massive gamma level at 400. You think that acts as a magnet, or 4,000? Think that acts as a magnet this week?
Yeah, and I think that could be a magnet. And if we pull that out to the chart, let's go ahead and do that. A lot of that could also be, you can just see the gap that's out here as well too. I mean, there's a huge gap that's on the cash market, and it's not that gaps have to be filled, but it does tend to, it reduces the complications. I'll just put it that way when gaps are filled. So
I might add that the S&P is only up 2 points now, and it was up 35 points 10 minutes ago.
Yeah, so I mean, I wouldn't mind seeing a decent pullback to, this would be a 38.2 pullback, which is just classic. If the price were to go back down to 39.50 before launching higher, I love to see, not that it's fun to go through, but I love to see pullbacks that disappoint people, because that generates the negativity required to get this thing to squeeze to the upside. And that's the way markets operate.
Yeah, we are giving it back now. It looks like. So I'll have to see what the news was to end it, unless, you know what, maybe he's taking questions now. That's the problem. Let's see here. Oh, Yellen's speaking too. Yellen, we are not considering insuring all uninsured bank deposits. Well, that's a departure from what they said earlier in the week. Fiscal impulse is not driving inflation right now, Fed's Powell. Now that's interesting. Money printing by the federal government and all the spending is not driving inflation. I don't know if I believe that. So yeah, it must be he's answering questions and it's taking things kind of the other way. But last thing, I think I saw one more question on here. Let's see here. What do you got there? There's a Oh, a low probability question. I would say, yeah, save that for the trading room tomorrow with Doc. So we'll stay on just a couple minutes for the last Q&A. So if you got any more, send them in. But we'll spend maybe a couple more minutes and then we got to jump.
Yeah, just watching this thing, it's we've some of these moves are incredible. I mean, it's like those are 60-point moves. These are not insignificant.
Always on Fed Day.
Yeah, these are not insignificant. So these are the reasons why we typically do not trade over these days. So even though you can trade directionally if you want to on days like this, for option sellers like Dave and myself, these are days where we let the let the retail drama play out.
Yeah, we are negative now on the SPX. NASDAQ is only up 33. We're dropping precipitously. It looks like, hey, look, you're back into that range with your VWAP there. So I wonder if it breaks through that opening range. Looks like it is right now.
And there's a big gap down there, and there's the 4,000 level that Brewhead was talking about.
Yeah, you're just talking about that. Have all filled, some in a day, others in a couple months. Yeah. So that's why I said 3 p.m. hours, what matters? Watch what happens in the 3 p.m. hour. So here we go. Definitely. Even looking at the Russell, it's down almost 20. So a lot of times the Russell leads over the others. So
and again, guys, don't get too excited about today. Like let the overnight market watch tomorrow. We'll find out by tomorrow's opening range which way the market wants to go. Usually within the first hour or so. If we're going to get a trend day, we're going to find out about it early. It's not going to be something that the market's going to be coy and hide about. If it's going to fade this move, it's going to fade it tomorrow. First thing out of the gate, boom, it's going to be gone. Right?
Yeah, I would expect the NASDAQ is at a point, the NDX at a point where it should pull back. It's outside the upper Bollinger Band. It's pretty exhausted. So I wouldn't be surprised to see that pull back some. SPX could still run. The Russell actually has been kind of at the bottom end of the range. I could see it hovering in here, just continuing and maybe continuing putting in support and bounce higher. But I think in the shorter term, probably the easiest pullback would come from the NASDAQ.
Yeah, no doubt. And we're looking for money to rotate into the Dow, which would be a very, very defensive.
Rotate out of there.
Yeah, rotate into the Dow, and that would be a very, very defensive out of growth and back into staples and things like that. So, well, I think we have reached our time limit here today at 12-minute trading. We want to thank everybody for joining us and some great interactions, terrific questions coming in. And we do this once a week. Typically, we do these on Mondays, but depending on travel and stuff like that, we'll make sure we always do these things. So we'd like to join you guys, or like to thank you for joining us, and invite you to also, hey, if you check the comments in this video today, both Dave and I are presenting. I'm going on Thursday tomorrow, and Dave's on Friday. Yep. So you can, if you want to just check us out and see what we do, go sign up for those seminars. They're free, and you can watch some other people too and get some good trading and education. And then join us.
I'm going to be going pretty in depth on the philosophy behind why I trade the way I do and all that stuff in those. So if you've never seen me before, or just want to learn more about how I think about the markets and how I structure my trading strategies, great session to check out. And it is, like Doc said, it's free, and you'll get a lot out of it just spending 45 minutes of your time there. So,
right. Okay. Well, thanks everybody. So from myself, Doc Severson in Greenville, South Carolina, and for Dave Lukas in Delaware, Ohio, this is 12-Minute Trading. Signing off and thanking everybody for joining us once again. Enjoy the Fed Day. We'll see you soon.